Okay. There we go. So I think I've got it all. It took me a second. It's just testing my connection over there on Facebook Live. And we are live on multiple channels. Awesome. So without further ado, today's session is going to be on understanding source deductions, which if you are new to us, it's probably going to be a little bit overwhelming to you. And I just forgot one pretty critical piece. I got to give those of you who are listening on Instagram some sound. So don't mind the double mics. I apologize, everyone. Again, it's one of those weeks. As some of you know, I'm in the process of trying to cut back on smoking, and it's just it's making for a fun experiment. Let's just say that. So again, today's session is going to be on understanding source deductions. For those of you who are not familiar with our firm, my name is Andrew Wall. I'm the managing partner here at CPA4IT. We've been specializing in independent contractors since 1984. We are a multi-generational firm founded by my father, George Wall, back in 1984. We specialize in service-based businesses, primarily in the IT industry. And we are also an ISO 9001 registered firm, which basically just means we have systems and processes that are independently audited and verified to make sure we're not only doing what we say we do, but we also have a process for constant, never-ending improvement. So the point of today's session is to talk to you a little bit about payroll source deductions and help you to understand exactly what those are. So when you work as an employee somewhere, your employer is responsible for withholding a number of taxes from your paycheck and remitting that to the government on your behalf. And that's what payroll source deductions are. So source deductions made at source, which is where they come from. So as an employer here in Canada, you are responsible for withholding and remitting income tax, CPP, and EI where applicable. So these things, along with any payments that you're going to be made, must be received by CRA before they're obviously appropriate due dates. We're going to be talking specifically today about what those due dates are, because they can get quite complicated. We have different thresholds, different remitter types, and different deadlines based on what those are. But if you've never done payroll before, if this is your first year with a business, this can all seem overwhelming and confusing. It is really important to pay attention to this because the deadlines for missing a source deduction payment are some of the steepest penalties that exist with CRA. It's 10% the minute you are late. So it's really, really absolutely critical to make sure that that is done accurately and on time. Now, there's great payroll software out there, WagePoint, to name a few. QuickBooks has their own payroll platform. There's a number of different tools out there that will help you make sure you get those payments done and those calculations done correctly. Today, we're going to be talking specifically more about those independent contractors who are typically paying themselves with the stroke of a pen, typically once a year. And that means that basically your salary is more of a deemed salary rather than an actual salary. For many of our clients, you'll be withdrawing money out of your corporation throughout the year to pay for various expenses that you might have, and we consider that a loan throughout the year. At the end of the year, we look at how much money you've withdrawn from the corporation to do your actual tax planning. And then based on that tax planning, you'll have a deemed salary, which is typically done once a year. Since the last day of the year that you can declare a salary is December 31st, that will typically be declared in December 31st. And for most of you, that means you're going to have to make your source deduction payment in either January 3rd, 10th, or 15th. You'll notice that in all of our mailings and all of the deadlines that we give you, we're always going to say the 3rd of the following month in which your payroll is remitted, which is the absolute worst case scenario. You may in fact have a few more days than that, but we'd rather under promise and over deliver. So we always help you to shoot for that earliest of all deadlines. And in many situations, as you'll learn today, your deadline could in fact be either the 10th or the 15th, even though we've set the target for the 3rd. So the deadlines, they do vary based on remitter type. We will be going through those as well. So the big question here is, are you going to need to make a remittance for 2021? Do you want to declare a salary in December and make a payroll tax remittance in early January? So there's a couple of big overlying questions that help us determine that when it comes from a tax planning perspective. So the first question that we're going to ask is whether you have income from any other sources, and if so, how much? The reason that we're asking that question is because we want to understand, is there room in some of these lower tax brackets where it would be tax effective to declare a salary for you from your corporation? Because there's a certain threshold where below which there's a reason or a benefit to drawing money out of your corporation and declaring it as a salary. Usually what I look at is what we call the effective tax rate. So you'll hear me talk about effective and marginal tax. So effective tax is just your total tax divided by your salary, gives you your effective tax rate. Your marginal tax rate is the tax rate on the last dollar of income that you've earned. And because we have a tiered tax system where we have these different brackets, and you might be at a higher marginal rate, but when you average that, you always have a lower effective tax rate than whatever your marginal rate is, because the marginal rate is just the tax rate on the last dollar. But if you have an effective tax rate that's lower than the corporate tax rate here in Ontario of 12.2%, it makes sense to pull that out of your corporation and have access to it outside your corporation at a rate that's effectively the same as what you'd pay inside of a corporation. Now, the marginal rate might be higher, and that's then short-term planning. You might go, hey, if my marginal tax rate is higher, I better just leave it in the corp because I'll pay less tax. That's true for today, but keep in mind that once this year comes and goes, there's no going back to get advantage to those low tax brackets. So we do want to leverage the power of these low tax brackets in order to make sure that we're at least getting money out of the corporation at the same rate as it would cost us to leave it inside the corporation. So that first question is, do you have income? Because that's going to drive us. If you've got income from, either a job that you were working before you started your own business, you're probably not going to want to declare salary for you. Or if you've got salary or income, I should say, from investments, or there's something going on, we want to know that because that's going to affect our tax budget. The next question we want to know is, have you already declared income from your corporation for this 2021 fiscal year? And if so, again, how much? Again, this comes down to wanting to get the tax planning right based on various tax brackets. But one of the things that some of you might realize is that when you own a corporation, you can expense in the current fiscal year salary that has been paid anytime throughout the first fiscal year, as well as bonuses that will be paid out up to 6 months, or actually 183 days from the end of your fiscal year. And so what that means is that if you had, let's say, anywhere from July 31st, 2020 year end and onwards, you could have declared salary that would be bonused into the 2021 calendar year. So July of 2020, you might have done a bonus that would be 6 months out, that would have been into January of 2021, which would mean that you might have salary already coming from your previous tax years. So these are really important questions because, again, if we're targeting getting money out of your corporation as tax effectively as possible, we want to understand what kind of room and eligibility that you'll have in order for us to declare salary from you. So those are the first questions that we have. Now, assuming the answer to those is no or below the lowest tax bracket, we're probably going to want to declare some salary. So now we have to dig into how much should that salary be. So one of the big questions we want to know is, how much money have you withdrawn since your last corporate year end? This is what we refer to as your director's advance. As we said earlier, the money you take out of your corporation is often considered a loan or an advance from the corporation throughout the year. But there are some rules put in place by CRA that basically are put in place to prevent you from just taking money out of your corporation without ever declaring a salary. So for the most part, and there's always exceptions to pretty much every rule, but for the most part, if you take money out of your corporation, we're going to have to declare that as a salary. So that's the first question we want to know. How much money have you physically withdrawn from your corporation during this calendar year? Because that's going to be probably our largest guiding factor for determining what we should declare for you as a salary. Next, we'll want to know if you made any contributions to RSPs or if you plan to make any RSP contributions before the deadline at the end of February. This is important because RSPs are a tax strategy that allow you to defer tax. They allow you to defer tax by reducing the amount of taxable income in the current year for any contributions you've made to RSPs. So if you've made a large RSP contribution, we want to make sure that those contributions are being used at an effective tax rate. What I mean by that is I would never encourage anyone to ever make an RSP contribution at the lowest tax brackets, because then at the very best, the only thing you're hoping for is tax deferral. You'll never get tax savings. Tax savings for RSP work when you're able to contribute at a higher tax bracket than where you withdraw, because with an RSP, when you eventually pull money out of your corporation, it will be taxable at that point in which you withdraw it from your RSPs. Next, we'll want to know if you have a target net income. This is really important for those of you who are going out trying to get financing for a house or something like that. There might be a specific number that you are trying to achieve to make sure that you qualify for the mortgage or whatnot. So that's another important question we need to know and understand from you when it comes to this tax planning. And then lastly, but certainly not least importantly, is understanding whether you have any family members that we could do any income splitting with. That could be potentially children, spouses, cousins, aunts, uncles, parents. Now, there is a reasonableness test that we must use when it comes to income splitting through the use of salaries. So it's really important to understand that when it comes to income splitting, we have to make sure that the salary we're paying is reasonable, number one. Number two, we also have to have the flow of money. We need to see the transaction happening, going out of the corporate bank account and into the other individual's account. So we have that audit trail. Now, if it's your spouse, they'll generally accept that you and your spouse might have a shared account, so that's okay. But for children and for aunts, uncles, parents, we want to see that flow of money. And then we also want to see a job description and invoices to help support that. That's sort of the ideal sort of documentation when it comes to income splitting. But income splitting can be really, really effective because the more time that we can smooth income and the more people that we can smooth income over, the less you will pay in total taxes. And that's simply, again, because of this marginal tax system, where you can imagine one person at $100,000 versus two people at $50,000. The two people at $50,000, because they're in lower marginal tax brackets, will pay less than the one individual making $100,000. So those are important factors to consider. So once you've worked with your accountant, you've answered all these questions, and you've come up with a dollar figure for what we're going to declare as salary and the number of employees that we're going to be paying in this remitting period, we need to figure out, okay, what remitter type are you, and what is the actual due date based on your remitter type. So remittance due dates are always based on when the employees are paid. So for many of our clients, because that's done with a stroke of a pen, it's typically only done once a year. We'll typically only have that one deadline. However, if you are making payroll payments to either family members or even to yourself throughout the year, you will be responsible for having monthly payroll remittances, unless you fall under this quarterly category, which is pretty rare. It would have to be a small amount. We'll talk about that in a second. So the deadlines are going to be either the 3rd, the 10th, or the 15th, depending upon what remitter type you are, which we're going to cover in the next slide. If your due date does happen to fall on a Saturday, Sunday, or public holiday, you do have until the next business day, which is important to be aware of. If your business happens to go bankrupt, you have to remit within 7 days following the closure or bankruptcy of your business. Hopefully that's not relevant to anyone here. And then you have to make your payment by your remitter deadline, which is based on your remitter type, which is based off of your average monthly withholding amount. Not from the current year, but of 2 calendar years ago. So I swear they do this just to make things confusing. So now let's look at what are the different remitter types, and understand that this is your average monthly withholding amount. So again, ultimately for most of you, this is just going to be the one-time remittance that you have made. And was that basically, more or less than 25,000 or more or less than 100,000, because these are the major thresholds that we have. The majority of clients typically for us will fall under a threshold 2. So if you're making a payroll tax remittance that is less than 25,000 and you're only doing that once a year, your average monthly withholding amount, because you've only got one withholding amount and per year, that makes it really easy. So it's whatever that amount is. You would have until the 15th of the following month. So if you made a remittance in December or a salary payment in December, it would be due by January 15th. If your remittance amount from 2 years ago was more than 25,000, but less than 100,000, which is where most people fall, your deadline is actually going to be the 10th. And if that amount is more than 100,000, it would then be the 3rd. So again, we go and tell everyone all of our plannings, all of our year-end checklists, they're all going to say the 3rd. This is just really helpful because we've seen more than one occasion where people didn't see the deadline, and not having those extra days actually comes in handy more often than not. So we'll tell you it's the 3rd, and in many situations, you're actually probably going to have at least to the 10th and possibly to the 15th, depending upon your remitter type. Now, the other thing to be aware of is that you are a new remitter or a regular remitter until you have 2 years of history. Because remember I said that average monthly withholding amount is based off of the average monthly withholding from 2 years ago. So for your first 2 years, you are a regular remitter because there is no history to go on. So that is important to know. There is also this quarterly remitter type that is available if your if your average monthly withholding amount is less than $3,000. Very few people fall under that. And again, what's important to note is these thresholds that we talked about before, they're assuming that you have to pay them whenever you make a payroll remittance. So CRA is used to most companies who are making payroll remittances every month because they have employees that they have to pay every single month. And so if you're paying an employee, you're supposed to withhold tax from that paycheck and remit it to the CRA in the month with following that payroll payment. Now, when you're self-employed and you're only doing that once a year, this quarterly remitter doesn't actually benefit you, because even though you're technically on monthly payroll, you only have one payroll payment per year, which means you only have one monthly remittance. Some people think that means that they're on annual payroll. They're not. You're still on monthly payroll. You just only have one payroll run per year, which is a really important difference to understand. And this can be very, very confusing, particularly in your first years, which is why we've put together these webinars, which was why we'll open it up for Q&A at the end, and we'll be able to answer any of the questions that you have. So the new remitter, as I said earlier, is for new employers. And you do need to apply for a business number or a payroll account number with your business number if you haven't set up a payroll account before. A little trick that we have learned along the way, if you ever actually just make a payroll remittance using your business number followed by the RP00001, they will automatically create an account for you. That's a good fallback solution if you ever get up against a deadline, but I don't recommend that. I do recommend calling CRA and setting up an actual payroll number as soon as you can. I do see some chat. What happens to withholdings when the employees are overseas? So you're still filing a T4 non-resident. So they're still responsible for filing a tax return. And so maybe what is an important thing to understand is what is happening here. Let me take a step back and help you understand what's happening. You're taking money, you're withholding it from the employee, you're giving it to CRA, and you're saying these are the withholdings based on the information that we have, based on the payroll numbers that we have. You will then prepare a T4, the employer prepares a T4 that tells the government what the salary was, what the social insurance number was of the employees, how much their salary was, and how much payroll remittances you withheld, including the CPP and EI, if applicable. And then at the end of the year, the employee would file a tax return. Included in their personal tax return is their T4 slip, which tells the CRA how much the employer paid the employee, and how much they withheld. And then they'll have a whole bunch of other things. They might have rental properties, they might have donations, they might have childcare expenses that ultimately dictate how much they should be taxed based on their income and all these other factors. And so based on that, CRA will say, okay, your employer has withheld enough. And in fact, we owe you money back and you're getting a refund, or your employer didn't withhold enough and you actually owe and you have to pay that at the end of the year. So they would still be responsible if they're non-resident to file a tax return and potentially get a refund and or potentially owe, which is 100% dependent on their individual situation. As you can imagine, there's so many other factors that go into whether the amount that's been withheld is actually the amount that they will owe for their personal taxes. In most situations, people will have other deductions that result in a refund in most employment situations. Typically, if you have more than one employer, in that situation, you're usually going to owe because both employers are, assuming that they're using the lowest tax brackets when one of them is going to be stacked on top of the other. But I digress from that. Getting back to setting up your payroll account. When you do set up your payroll account number, CRA will send you a remittance form. Now, if you want to be able to walk into a bank and make a payment at your bank, you absolutely need this remittance voucher form. You can't make a payment at your bank without this. And we can't print it for you and give it to you. It's got to come from CRA. So that's a really important thing. If you're thinking you want to pay old school, walk into a bank and make a payment, you should be setting up your payroll account now. And if you don't already have a payroll remittance voucher mailed to you, you might want to contact CRA to get one sent out to you so that you can do that. Now, the good news is there's lots of other ways that you can pay where you don't need to physically walk into a bank and you don't need the remittance voucher. And we'll be covering the payment methods later in this session as well. And remittance methods. So here we go. So there's online banking, and we've got some instructions you'll find, in fact, in the body of my email. You'll see whenever I reply, there's an auto thing there that shows you how to make any online CRA payments. We do recommend using the online banking method as opposed to logging into the CRA and making a payment through the CRA's portal, just simply because if you use the CRA portal, it's basically Interact. It is limited to typically $3,000, but it's whatever your Interact payment method or limits are. So you can do that through the My Payment and the My Business account. You can do pre-authorized debit. You can do, you can pay by credit card now with Plastique and other things, but they do have a processing fee. So if you're like, I'm going to go get points, this is a great opportunity, which I'm a big fan of points. And, we're trying to get the Prince of Travel on to talk about points. It's a whole nother thing. But it's going to cost you more in service charges than it's going to be worthwhile in points. So this is really, if you're in a cash flow crunch, you can do that through Plastique and other various third-party providers. You can pay with your Canadian bank account by walking into a bank or by doing a wire transfer. You can also pay by check. Just make sure if you're paying by old school check that you are putting your payroll account number on there and the remitting period. So when you make a remittance payment, there are 3 key pieces of information that you need to provide to CRA. The number of employees, the gross payroll, and the payroll remitting period. So this is really important. Often people get this part confused. So if you're making a payroll remitting payment in January, it would be for the period in December, not necessarily your year end. As we said earlier, you can imagine you could have someone who's got a July 31st year end that's bonusing a payroll out till December. They wouldn't put July as their remitting period. The remitting period is December. So the remitting period is the period in which you are paying the employees. But that's really important. Again, you can pay in person at either a financial institution where you will need that slip or a Canada Post outlet. I believe at the Canada Post outlet, you need that slip as well from CRA. That slip is called the PD7A. It is sent to you by CRA. It is personalized. As we said before, we cannot give you a copy of that. Effectively, what information you'll need to complete on that slip is the same information we've just covered, which is number of employees, gross payroll, remittance period, and of course, the amount you're actually paying as well. So I guess there's 4 things there. If you're not going to be making a payment for whatever reason, you need to let CRA know. Otherwise, they're going to be like, hey, where's my payment? Why didn't I get payroll remittance? You paid me last year, you didn't pay me this year. What's going on? And in fact, in many clients who will typically do payroll remittance once a year, one of the things you'll get is a letter in the mail saying, hey, how come you don't have a payroll remittance this month? So you can let CRA know that you won't have any more payroll remittances until whatever the next time frame is. So if you're doing this annually, you want to let CRA know, hey, I won't have any more payroll remittances until December of 2022, right? I do it once a year. So you can do that either online. You used to be able to do it by a phone, which I think you still can, but they are actively trying to phase that out. So I'm not 100% sure that you can still do it by phone, but you certainly can do it in the CRA website. And then you could also, again, do it by mail. So again, on your PD7A form, there is a way to say on that you won't have any more payroll remittances until whatever is your next period. So you can use that form as a method to tell CRA, I'm not expecting to have any more payroll remittances until next December. So let's imagine you do one, you make a payment manually for December, you get a payroll remittance stub for January. In that one, you fill it in, you complete it, you send it back, and you say, I'm not going to have any payroll remittances until the following December. Now, how do we correct either an under-remitted or an over-remitted payment? Because these are common things that happen. In fact, in many situations, because of the deadline and the penalties associated with the deadline, when we get up against a wall and we don't have time to go through your tax planning, we're going to give you an estimate, which is just that, an estimate to use so that you can make a payment and not be late with your deadline. That could be either too little or too much. And how do you handle that situation? So when you have an under remittance or an over remittance, typically that resolves itself out because we'll prepare the T4 and we'll say, hey, this is how much has been remitted. When you file your personal tax return, that under remittance or over remittance will be taken into account. And as long as you have covered the CPP, both the employer and employee portion of the CPP, that's the minimum amount the employer must withhold. Okay. When it comes to tax, the employee is allowed to tell the employer not to withhold the tax because they might have other credits that are going into affecting what their personal tax rate is. So they can tell their employer, I don't want you withholding any tax, but the employer must withhold CPP and EI. So if the under remittance is below the CPP amount, you're going to have to make a payment to top that up, and there will be potentially a late penalty. But as long as it's more than the CPP, then don't fret about it. Don't worry about it. You will have to pay the difference when you file your personal tax return in April. Now, one of the other common things is a misapplied payment. So a payment will be applied instead of to the December remitting period to maybe like a July year-end period or October or November, and then you'll be hit with a penalty. That's really easy to clear up. You just simply give CRA a call or go on to your My Business account, make the correction, tell them what period it should be for. They'll then typically waive all the penalties that you were charged, assuming that it was actually on time for the right period. This is a common issue that we do see regularly. So if you get that, don't fret. As is that letter where you're being told you've changed remitting thresholds. This is a common thing that we see all the time. And people call us, oh, what do I do? They told me I've changed my remitter threshold and now I have to pay every month. You technically have to pay every single month anyways, no matter what remitted period you're on. You just only have one payroll per year, which is why you only pay once a year. If you were making multiple payments throughout the year to yourself, you would be required to do monthly payroll. But when your remitter threshold changes, that doesn't mean that you now have to necessarily make a monthly payment if you're still doing it where you're doing a salary as what most of our clients do, stroke of a pen, done once a year based on tax planning with your account. So those are important things to know and understand. I got a question coming in here. I'm going to try and get to that before I go on. Do I have to do a payroll remittance if I'm taking money of my company that are director's advances? So director's advances are a loan. Those don't trigger payroll. However, there's rules around those loans that basically say they have to be basically repaid within a year. And the most common way of repaying that is to declare them as a salary. So the director's advances themselves aren't your payroll, but they are in most of our clients what is going to determine what we declare as your director fee. So director's advances, money you've taken out as a loan. Director's fees, the salary we declare to clear the loan. Okay. So it's important you have a discussion with your account manager to determine whether you need to do a payroll remittance this year. But generally speaking, if you've taken money out, we're probably going to need to declare that as a salary. Okay. There's always a trick or two up our sleeves. We've always got one or two up our sleeves. But we are limited, right? We are limited. And oftentimes we are limited by the actual actions that have taken place. And so speak with your accountant and your account manager, and they'll help you figure out what to do from a tax planning perspective. And what I would say is you've probably received an email just the other week from us with our source deduction planning worksheet. I would recommend completing that and sending that over to the accountant, even if it's not, if you're not 100% sure how to complete it, do it at the best of your ability. That'll just arm them with more information so they can make that call with you more effective. As I said earlier, the failure to file penalty on payroll is the steepest of any taxes. It's 10% if you're a day late. In addition, if you've missed more than one payment, they can ramp it up to 20%. And so the penalties here are very, very steep, which is why we do webinars, we do reminders, we over remind when it comes to payroll remittances. And that's because the penalties are so steep. Again, the minimum, if you are in a time crunch session and you won't have time to figure out the planning, at minimum, pay at least the CPP, the maximum CPP amount for the number of employees that you plan to do any income splitting with. That'll give us time to effectively do a little bit more tax planning between now and when we actually have to file the T4s. The T4s have to be filed by the end of February, but the payment in most of your situations is going to be due January 10th, although we'll typically tell you to be by January 3rd. So those are the failure to file penalties. And that brings us to a close. So I apologize, this is the first time I'm doing this webinar since last year. We will be coming back and doing more of these webinars. I do want to open it up for a Q&A. If anyone has any questions, please do post them either in the chat or the Q&A. I'd love to answer your questions, because I know that this can be a little bit confusing in your very first years. And particularly for our little niche, which are service-based professionals, small owner manager type of businesses who aren't typically doing a monthly payroll. If you're doing a monthly payroll and you're using a payroll software like WagePoint or QuickBooks Online or Payment Evolution or any one of those things, this is probably all being handled for you without you even having to think about it. But hopefully you're at least working with your accountant to do a tax planning strategy to make sure that that salary that you're doing through this payroll software is a tax effective strategy. So again, thank you. I don't see any questions coming through right now. Hopefully we got through those questions while we were live in the session. If something does come up, we will be having another one of these sessions in 2 weeks. So come back to that session. This is a great way to get your questions answered completely free of charge. Of course, if you do want to reach out and speak with your accounting team, they are there. Unfortunately, their time is billable. So thank you, everybody. And I'm logging out. Oh, sorry. Caught it right in time. Can we declare money that we have taken from our business as management fees versus dividends or directors' advances? Again, money you take out of your business throughout the year is typically going to be deemed to be a loan. That loan can be cleared either by repaying the money, which doesn't often happen, or it can be cleared by taking that loan and converting it into either a salary or a dividend. The difference between a salary and a dividend is that a dividend does not have any withholding amounts on it. So all the stuff that we're talking about here, payroll remittances, source deductions, do not apply to dividends. Dividends are a share of the profits issued to shareholders. And it's the shareholders who are responsible for remitting the taxes when they file their tax return in April. Can your director's advances be considered a dividend? Absolutely. Does that make sense? Depends on your individual situation. And that's why you really need to speak with your account manager. Now, typically, our general strategy when you're in your income earning years is to take money out in the form of a salary. We believe that that's a good strategy because it does build up some CPP room because of the CPP contributions. It does build up some RRSP room. Well, we personally believe in those strategies. If you didn't believe in those strategies, you could elect to use dividends, and all of the stuff that we've talked about today becomes irrelevant because you don't do source deductions or payroll remittances on a dividend, which is not a salary. Now, one of the other things to keep in mind is that if you have taken a year off of contracting, but you have a bunch of retained earnings and you want to pull those retained earnings out of your corporation, we're typically going to do that in the form of a dividend because you have no income to apply the expense of a salary against. So a salary is a deductible business expense that comes off of the profit and loss statement. A dividend comes from your balance sheet and doesn't reduce the taxable income of the corporation. And it comes out of money that has already been taxed out of what we call retained earnings, money that's already been taxed at the corporate tax rate. Because of that, you will get a dividend tax credit personally. The way the two are treated is very different. Fundamentally, the tax, when you add all the different taxes together, is going to be very similar. The only difference is going to be the CPP and EI, if that's applicable, because those aren't taxes. Those are pensions and insurance. So hopefully that answers your question, because I know you guys are watching on Facebook, not here in the Zoom. So I believe that's all of the questions. Again, thank you. For those of you who are on Instagram, I do see a number of you here. If you've got a question, try posting it in the chat, comment. I will try and answer that. Otherwise, it's time to say goodbye to everybody. I guess I'm over there. And we'll see you back with our next webinar. Bye for now.